Today's video is very important. Every single person here, I feel like everybody when they first got started in trading saw big profits, saw the Instagram lifestyle, and that's what you want to skip to. That's the end goal. You want to see big green days, you want the Lamborghini in the garage, you want the big house. Every single person that actually lives that life for real, really trades, really invests, really dabbles in the financial markets for an income that they live their lives on. Those people understand one key aspect, and it's the basics, the fundamentals. It's very easy to overlook that, to run to the big shiny stuff, but remember, the fundamental base is how you build the correct building blocks of being not only a profitable trader, but a profitable investor. Today, I'm going to be covering some very basic concepts. What is even the stock market entirely? What exactly are we doing here? What if I told you that you can buy a piece of a company like Nvidia, Apple, Microsoft, Amazon, some of your favorite household names? Think about purchasing a stock as basically purchasing direct ownership of that company. How exactly? They divide it up into shares. Shares are the fractional pieces that you buy to own ownership directly in a company. Why do companies even make it allowable for you to own a piece of the company? Why would a company so big like Amazon even want to make it available for someone like a very small retail trader or retail investor or a massive whale that might already own some exposure? They're always looking for funding, always looking to raise capital. And that is what offering is, a public stock, being able to trade it publicly. That's what shares are. They're dividing the ownership stake in to receive capital in return for the purchase of those shares. Imagine you owned a pizza shop, and imagine you had $10,000 to your name as the owner of this pizza shop, but you wanted to buy some very specific pizza ovens that cost about $100,000 to be able to actually scale your pizza operation. What you can do is selling of shares, selling ownership of the company. Imagine if I was to take and divide the pizza shop ownership into 1,000 equal shares or slices of that ownership. And let's say I charge $90 a pop for each share. That is me giving out portions of ownership of my company to be able to raise capital to scale. Companies do this, they raise money without taking out massive amounts of debt. They give up ownership percentage. That is the fair and change transaction. This is very common in a lot of growth stocks, especially whenever we're in high interest rate periods, because the whole purpose of this is for companies to avoid going into debt to raise that capital. They rather give it all back like that in shares and even eventually do buybacks once their investment is successful and they have more cash on hand and they can actually buy those ownership shares back. Always a little bit better than raising debt, but it usually dilutes price on the stock and can make it seem like, hey, they might need some cash for some scale. So investors sometimes don't take that as the best whenever a new company or a public company that's already traded publicly starts offering more shares of ownership for more increase of capital. We've already talked about what a stock is, what a share is, and really why these companies do it. That's what benefits them. But if we're the ones going to be buying these shares, what benefits us? How do we make money off of these purchases? Well, we really make money in two ways. Number one way is the value of the company goes up. So the stock price goes up, meaning I bought in shares of Amazon at $100 a pop. Amazon grows and doubles its business within a year. Now those same shares are worth $200. That means whatever I invested in at $100 a share is now worth double. That is one way that we make money from an investment perspective when we buy a small ownership share of these companies. The other way we make money is in dividends. Think of dividends as almost like a profit sharing. Not every company pays dividends, but most companies do. That dividend is like a profit sharing at the end of every quarter for its investors or the owners of the company. Now remember, this sounds fantastic. It's always double-sided. There's always an equal or greater risk depending on what you're doing. So just because it can go up and you can make dividends, it can also go down. Let's say I was to run my pizza store poorly. I raise a bunch of capital at $90 a share. All of a sudden, pizza machines aren't producing, revenue's dropping off, we're losing customers. Now all of a sudden, in reality, the shares are worth $40 a piece. Now all of my investors that bought in at 90 are losing money. As much as it might seem fantastic for you to make money, there's always equal or greater risk on the downside. So you have to understand both sides of the equation, mitigate your risk and stay risk neutral, or at least understand and know your risk as much as possible so you can mitigate against it at all times. The last question is, how exactly do we actually purchase these shares in this stock? You don't just walk up to the Apple store and ask one of the tech employees, hey, can I buy some shares of Apple, please? It's not how it works. You go to the New York Stock Exchange. Nowadays, it's so easy. You can download an app like Charles Schwab, create an account, and directly buy shares as easy as that. You can even download a company like Robinhood, and you can buy shares almost instantly. There has never been an easier time to buy ownership shares of this company. There's more money now in the markets than there ever has been, and I don't think that trend is going to go away anytime soon with the way the industry industry is turning. So there's never been a better time to not only educate yourself on how to invest and how to trade, but get familiar with it and really add it to your repertoire of income sources as time goes on. So just to kind of recap everything we went over, a stock is a small piece of ownership in any respective company. That ownership is owned through the purchasing of shares that are offered on the New York Stock Exchange. Why do companies allow that? To raise money. Why do investors purchase it? To make money. And remember, the forefront of every single investment is always understanding where your risk lies and understanding where the upside is. If it's worth the risk, don't be afraid to take it. Remember, the market is designed to go up, and it's been doing so since the early 1900s and hasn't stopped yet. Guys, I hope this information was helpful. If it was, please leave a like, comment. I appreciate the feedback always. Please be honest what you guys want to see more of. Thank you guys for your time. Again, my name is Joseph Murphy, JGM Trading, and I'll see you guys in the next video. Peace.